Hello and welcome to Investing Confidential. If you're listening to realtors or these financial experts and speakers who are talking to you about real estate, uh, they're going to tell you that they're seeing the worst is over, that things are stabilizing, and that real estate's going to make a comeback. I'm going to tell you right now, do not believe a word they tell you. Okay. The reality is that the real estate data is getting worse and worse. And what I'm about to show you, especially in some charts towards the end of this video, the worst is yet to come. Okay, so if you're a real estate investor, you should watch this. Okay, so let's start with the data. Okay, we always start with the data, and we have to take the data for what it is. We take the National Association of Realtors, just came out a couple of days ago with existing home sales. Okay, National Association of Realtors, obviously they are incredibly biased, but this is what they're showing you. Okay, here's the data. Okay, as you can see, existing house sales came out down again. 12-month low, down 30 again for January, down 36% from a year ago. Okay, this is going to continue, folks. It's going to be a slow drip. Okay, this drop in sales is just a leading indicator for prices. Prices haven't moved. In some cases, prices may have ticked up a little bit, but prices are not moving because there's a massive spread between the offer prices and and the bid prices. Just like stocks, bid and the offer. Okay, what people want to sell it for and what the reality is. Okay, there is low inventory. Okay, that's for sure, but it's growing. Okay, low inventory is being cited as a sign that people, the realtors tell you that low inventory is going to hold real estate up. It's going to stabilize. I say the complete opposite. So this low inventory narrative is incorrect. Okay, rising mortgage rates essentially are scaring the sellers. Okay, and I said there's a big spread. But the real issue, and it goes back to something I've been talking about that I guess is starting to dribble out now, but the main reason why we're going to see a big whoosh in prices lower is these large institutions still hold the big inventory. Okay, they are still holding on. They're selling drips and drabs. Okay, we're seeing in markets like Arizona, as you can see here, big real estate crisis. Prices are going down 25-30%. Okay, this is one of the big bubbles like Austin, Texas was, and we're seeing prices also in Austin drop. But the bottom line is people are very slow, human nature. They think the price is going to go up. So they lower the prices 2%, 3%, 5%. It's going to take 2 or 3 years, as I've said in the past. But the bottom line is as these rates stay elevated and this yield curve, as you're seeing here, continues to stay inverted, real estate speculators are not going to be able to hold on to these properties. There are people that have 8 properties, 9 properties, and they have big institutions with thousands of properties. All of them are going to have problems because the demand is gone. It's gone for quite some time versus previous 10 years. Okay, here's some data. Inventories, they're starting to climb. They're not a date, but they're going to climb. Large institutions are sellers, but here's what skews the data. They're selling through their own websites. They're selling through their proprietary selling. That kind of selling doesn't get picked up by the Zillows and other people. Okay, so these numbers are being skewed, but these institutions have no choice. The open door technology, they're going to puke this stuff out. Okay, here's the current situation. Look at the percentage of homes for resale that receive multiple offers. Places like Austin down the road in the past, we're down to 17%. Okay, that's probably because just of New York and Miami. Take New York and Miami out of the equation, it's probably much, much lower, probably negative. From a peak of 70%. Okay, that was a bubble. 70% of homes that were resale at one point were getting multiple offers. It's insanity. Okay, absolute insanity. And now I'm going to show you the most important real estate chart there is right now. So if you're a real estate speculator, watch very carefully. What we have here is housing prices and mortgage rates, what we call carrying costs, servicing costs, versus real estate valuation, price to income ratios, price to rent. This is stuff, this is real life stuff what we're talking about here. Okay, the carrying costs, servicing costs are are so high. They're back to 1980 levels. 1980s, we were coming off, I think, double-digit inflation. Rates were 8, 9%. Okay, in one point 1987, the 30-year bond hit 10%. Okay, so this is where we're at. We're at 40-year levels on affordability. This is all about affordability. Okay, valuation of real estate is at all-time highs. Okay? If this was a stock, you'd be a seller, not a buyer. Okay, again, confirmed by here CPI for shelter. It's back at 1985 levels. Again, coming off high inflation. So we're seeing levels of the valuations of housing prices that we haven't seen in terms of overvaluation for 40 years. It's incredibly overvalued. So, but where, there's real estate developers, where are they going? Okay, if you're a real estate developer, you might be buying, you might be building or developing multifamily homes. Okay, there's a bubble in overbuilding right now in multifamily. You know why? Because they believe they want you to be a renter. They want you to rent forever. They want you to be a Russian serf. They want you to own nothing and like it. This goes back to those morons in Switzerland. Okay, the New World Order. This is why they're overbuilding multifamily homes, so you can rent. They don't want you to buy, they want you to rent. That's why these institutions own all these homes. But the joke's on them because rates are normalizing and all this is blowing up. But the big issue for the economy and real estate is just starting to bubble now. I mean, this is the real gist of what I'm trying to say here. Let's start by looking at M2. Okay, M2 here is defined. It defines as money in people's pocket, essentially. Okay, money in bank accounts, money in people's pocket, et cetera, et cetera. The economists, the big guys, will try to tell you this is the state of government money printing. Okay, it used to be that when the government printed money, they printed money to put in the hands of the citizens so they could spend to rejuvenate the economy, stimulate the economy. This is the whole Ben Bernanke's famous helicopter money, just getting a helicopter and throw money out there. That's how you stimulate the economy. It's all different now. It's all changed. Okay, money printing doesn't go to people anymore. It goes to military spending, social net, overseas forays like Ukraine, everything but going into the consumer's hands. So when you look at this, okay, what you're really seeing now of M2, it's plummeting. It's gone. It is gone. Okay. You're at 40 plus year lows in M2. That means people have no money in their pockets, but they're still spending a little bit. And this is where it gets real ugly. Okay. Now I'm going to show you this. We as households, household debt, including mortgages, it's almost 17 trillion. That's all time high, 17 trillion. Okay, but the real danger in this is the credit cards. We are at credit card balances never seen before. Okay, and why is that dangerous? Because of the rates. They're 25, 30%. These are loan shark type rates. I mean, literally loan shark type rates. It's now going to reach almost $1 trillion. We're going to hit $1 trillion within a few months. $1 trillion of credit card debt. This is a disaster. Okay, this is not going to end well. So going back to real estate, ask yourself this question. People have no money in their pockets by M2. They are loaded to the gills in credit card debt. If you're a seller, if you're an owner of real estate, who's going to buy your house over the next 2 or 3 or 4 years as your interest costs are rising and your own carrying costs? Who's going to buy your house? I'll answer, no one. So if you're an investor, as always, you really better be careful out there.